Welcome back to Squawk Box. Despite yesterday's pullback in the Nasdaq, the index still sitting near all-time highs. Stocks like Facebook, Amazon, Apple, Microsoft, and Alphabet, they have been leading the way higher. Joining us right now to discuss whether the index growth is too dependent on just a few names, Paul Meeks is here, portfolio manager, investment committee member of Independent Solutions Wealth Management. Also with us, James Kakmak. He's the partner at Clockwise Capital. Good morning to both of you. I'll start with you, Paul. There's a lot of people on the skeptical side, on the bearish side, who say, you know what, the index is now so overweighted. I think it's close to, what, 18, 20% now in terms of the S&P 500, that it's so dependent on tech. And if something goes wrong or if even the mood changes, the mood much more broadly will change. What do you think of that?
I think you're absolutely right. And if you peel back the onion for someone like me who invests only in technology stocks, you take a look at tech-specific stock indexes, such as the SPDR tech sector, ETF, XLK, and that has about 70 names in that particular index, and 40% of that index is in just two of those names, Microsoft and Apple. So yes, the concentration is worrying, and particularly of those two, I worry about Apple. Microsoft, I think, is going to be okay, but Apple, I think there was way too much in this stock price based on a 5G supercycle, which I'm much more skeptical of than most.
I want to talk about both issues. First, let's just talk about the broad issue for a second. The implication, though, of the overweight relationship of these tech companies, there's nothing much you can do about it, right?
Yeah, that's right.
You can have these fears. We can all talk about these fears, but there's nothing, unless you have some other idea I don't know about.
Yeah, no, I think what you would do is, I'm a tech sector, and I tell people to be very careful investing in me or in any tech sector product. We can all take a look at the tech sector focus, and what you mentioned at the outset is true, but now there are 11 sectors that make up the S&P, and we also have communication services, which you have to include. And you also have to include some of the major consumer discretionary names like Amazon. And so the black and white technology sector exposure is actually less than you think. So you just have to take a look at portfolios and make sure that, if I was to give you a baseline, I would say make sure your portfolio is not more than about 20% tech. That's your stock portfolio.
James, what do you think of that? Is 20% the right way to think about it?
I mean, look, we have the increasing amount of the market explained by a narrowing set of companies. And we think that there's a handoff taking place. When you look at technology's evolution, we're talking it evolves in very long cycles, about 50 years. And we think a handoff is taking place where the last 25 years were about building out the internet infrastructure, and the next 25 years will be about how do we utilize it to improve productivity and time savings. The analog we derive is back to 1910, actually, with the railroads, where you actually saw 70% turnover in the Dow components for 2 decades, moving from industrial companies to consumer companies. So when we look at the tech sector right now, we think that the established companies, because of this transition, will be laggards, while new emergent opportunities that leverage what the establishment has built.
Like who? Give us an example.
I mean, we look at, you have, obviously, from the big tech, I think Amazon and Apple continue to be able to leverage their infrastructure. But then on the smaller side, you have companies like Slack, like Shopify, like Zoom that are building out, and you just reported Dropbox, for example, building on the cloud. These are companies that are leveraging.
So you're of the view that a decade from now, the 3 companies you just talked about, I mean, I don't want to put words in your mouth. You think they'll be bigger than Amazon?
I think Amazon and Apple, we carve those two out. But when you look at the $1 trillion club, I think that they will be laggards. They won't necessarily be eclipsed, but we have to look at, what is the transition going to take place, where which companies will outperform over the next decade. And I think through that lens, I think that's highly probable. Okay,
let me ask Paul this. Part of this, though, is a regulatory issue. By the way, in 1910, well, later, I should say, 20 years later, we had antitrust rules. We had antitrust enforcement in the United States. I'm not arguing that that's really happening, or right now it's not happening. There's a lot of talk about it. Paul?
Yeah, I think that there will be some hell to pay, particularly as what you're seeing that's starting, frankly, in Europe and coming to our shores about tighter regulations for privacy around social media, artificial intelligence. But I have to disagree with the other contributor in that as we build out this world, which he's talking about, a world of Internet of Things, there will be very big roles for some new Internet of Things component suppliers and some that are coming on the scene. So I don't know about if the FANGs are going to still be preeminent, but some of the component suppliers that exist today will be even bigger if this theme works out as he's talking about.